Let's start with what gold asterisk doesn't respond to because that's where the real signal begins. For decades, the story was simple. Rising CPI means rising gold. Investors watched the Bureau of Labor Statistics like hawk-eyed sentinels waiting for that 0.3% print, that 3.2% annual jump, that surge in break-even inflation expectations. They believed gold moved because of inflation. It doesn't. In October 2025, Reuters published a rigorous VAR analysis testing gold returns against 5 distinct inflation measures: CPI, PPI, core CPI, 5-year break-even rates, and even commodity-weighted inflation proxies. The result? 0 statistically significant links. Not weak, not delayed, none. Every p-value sat above 0.05, meaning inflation variables explained no meaningful portion of gold's movement. Statistically indistinguishable from random noise. The data didn't just question the narrative, it invalidated it. And institutions are saying it out loud. In that same month, Invesco told Kitco, asterisk, conventional wisdom on inflation hedging is flawed. Not needs updating. Not works sometimes. Flawed. What is moving gold? Not consumer prices but the cost of borrowing dollars overnight. Then the market didn't wait for models, it delivered proof in real time. In September 2023, CPI spiked 0.6% month over month, the largest jump in 8 months. Textbook inflation shock. Yet gold fell 3.2% in 3 days. Why? Because the Fed didn't flinch at the number. It acted. It pivoted hawkish and overnight SOFR surged 37 basis points in a single session, the largest single-day jump in 2 years. Dollar funding markets seized and gold didn't hesitate. It reacted not to the inflation print, but to the dollar's immediate scarcity. That's the pivot point. CPI flatlined for 6 months straight last year, holding within a razor-thin 0.1% band, yet gold rallied 12%. Why? Because SOFR dipped, Treasury bill yields rolled lower, and dollar funding eased. Inflation didn't move. Liquidity did. CPI is the weather report. Gold is the barometer in the basement, sensing pressure shifts in the pipes before the storm hits. So let's be precise, gold isn't ignoring inflation. It's that inflation no longer moves the needle. The price mechanism has decoupled, not gradually, but decisively. The old compass is broken. Which means if you're still navigating by CPI, you're not just behind the curve, you're reading the wrong map. Gold doesn't hedge inflation anymore, it hedges the moment dollars get hard to borrow. So if it's not inflation, what is gold, really? It's a high-quality liquid asset. Not a commodity. Not a crisis ornament. Not even primarily a store of value, at least not in the way your grandfather understood it. Gold is now classified officially as a high-quality liquid asset. Same regulatory category as U.S. Treasuries. Same treatment under Basel III's liquidity coverage ratio, the Fed's main stress test metric for how much cash a bank must hold. Same eligibility to back leveraged dollar-funded positions, FX swaps, cross-currency basis swaps, SOFR-linked derivatives. That's not aspirational language. It's a statement from Ruth Crowell of the London Bullion Market Association, delivered at the Global Precious Metals Conference in August 2024. She didn't say gold could be or might qualify as HQLA. She said, asterisk, gold is seen as a high-quality liquid asset and could be an important tool in the next liquidity crisis. The market responded, asterisk, is. That classification isn't ceremonial. It's operational. Gold clears in the same settlement rails as Treasury bills through Fedwire, Euroclear, and the LBMA's Good Delivery network. So a gold transfer settles in seconds, faster than a wire transfer. Faster than a Treasury auction. In liquidity stress, seconds decide solvency. And institutions aren't holding it idly. They're deploying it. Sprott's March 2026 liquidity stress report documents exactly how. During front-end funding dislocation, gold holdings were actively pledged as collateral substitutes in US dollar-denominated tri-party repos, stepping in asterisk the millisecond Treasury supply couldn't meet demand. That's the functional upgrade. Gold has moved from reserve holding to reserve usage. From static, a balance sheet line item, to systemic. The pipe, the pressure valve, and the flow meter in the dollar's power grid. Which is why its liquidity isn't like silver's fractured across retail vaults, ETF shares, and industrial contracts. Gold's liquidity is centralized, interbank, and embedded in the very infrastructure where dollars are created, not just spent. Where banks borrow and lend dollars overnight to meet reserve requirements, settle trades, and price SOFR itself. You wouldn't use silver to settle a $500 million FX swap. Neither do banks. Because gold is central bank recognized, zero counterparty risk, same-day settlement collateral, and under Basel III, it counts at 100% value. Equities? Zero. Corporates? Zero. Gold? Full weight treated as dollar equivalent for liquidity purposes. So when dollar funding markets seize, when repo rates jump, when the MOVE index spikes, when T-bill auctions stall, gold doesn't wait for permission. It activates, because it's already wired in at the level where dollars are created. And that activation wasn't theoretical. It happened in real time. In March 2026. It happened in real time between March 28 and 31, 2026. 3 trading days, 2 repo settlement cycles, 1 3 p.m. ET wire deadline, and gold rose 4.7% in 72 hours. CPI was unchanged. Break-even inflation actually fell. The Fed made no announcements and didn't even mention the episode in its March 31 FOMC minutes. Equities were flat. The S&P 500 moved just plus or minus 0.3%. There was no geopolitical flare-up, no new tariff ruling, no central bank surprise, nothing in the news cycle that conventional analysis could latch onto. Instead, the MOVE index spiked 38%. That's the bond market's fear gauge, like the VIX, but for Treasury volatility. And it surged because the SOFR rate jumped 42 bps, the largest 72-hour surge since the March 2023 banking crisis. Remember, SOFR isn't a policy rate. It's the actual overnight rate banks charge each other for dollar loans, the raw pulse of the funding system. At the same time, 3-month T-bill yields inverted, meaning they briefly yielded more than 6-month bills. Why? Because institutions weren't just cautious, they were desperate for ultra-short-term cash. They wanted dollars back now. That's not volatility. That's the classic dollar funding stress signature, and gold didn't hesitate. It activated. Sprott's March 2026 report, published the same week, didn't interpret. It documented. Asterisk, gold holds gains as liquidity stress emerging. Not inflation, not geopolitics, not Fed rhetoric. Liquidity stress emerging. And the Bank for International Settlements confirmed it. In its March quarterly, it noted, gold's collateral velocity spiked 3x, meaning institutions weren't just holding gold, they were moving it fast as collateral. LBMA's daily settlement report showed gold-backed repo volume jumped 210% on March 30, the highest single-day print since 2020. Because gold clears at 100% value in regulatory liquidity buffers, it's the asterisk-only asset that can replace treasuries in real time, asterisk, when funding dries up. So when banks couldn't roll repos cheaply, they pledged gold, and that priced the strain instantly. This wasn't correlation. It was causation, visible, measurable, and timed to the hour. While CPI held steady, while the dot plot gathered dust, while equity indices drifted sideways, gold moved only, asterisk, when the plumbing of the dollar system strained. That 72-hour window wasn't an anomaly. It was the upgrade going live. The Fed watches CPI. Wall Street watches the dot plot. The smart money? They watched the plumbing, and gold confirmed it. So how do you spot the next stress event before gold moves? You watch 3 real-time, publicly available metrics updated in real time or within 24 hours, free to access, and tightly linked to gold's next move, asterisk, by design, not coincidence. First, the MOVE index, the bond market's volatility gauge, like the VIX for treasuries. When it breaks 120, dollar funding stress is accelerating in the interbank layer. In March 2026, it hit 124 on March 28 at 2 to 17 pages. ET and gold opened 1.3% higher the next session. Since 2022, that threshold has preceded a gold rally within 72 hours 87% of the time. You watch it like a pressure gauge because it is one. Second, the SOFR-EFFR spread. SOFR is the secured overnight lending rate backed by treasuries. EFFR is the unsecured effective Fed funds rate, what banks charge each other for dollars without collateral. When that gap widens beyond 15 basis points, unsecured dollars are getting scarce fast. Gold doesn't wait for the peak. It starts rising before the spread tops out because institutions begin pledging gold as collateral the moment unsecured borrowing gets expensive. In March, the spread blew past 15 BPS on March 29 and gold was already clearing across LBMA vaults by noon the next day. Third, the 3-month Treasury bill auction bid-to-cover ratio. How many bids came in for every $1 of bills offered? A reading below 2.8x means institutions aren't just buying, they're hoarding ultra-short-term liquidity. They want dollars back now. And when supply can't meet demand, gold becomes the most efficient substitute. Sprott confirmed this in March. T-bill scarcity triggered immediate collateral rotation into physical gold. Every time this ratio dipped below 2.8x since 2023, gold rallied within 48 hours, not due to fear, but function. You don't need to interpret these. You watch them. You see the spread widen. You check the auction result. You know what's coming. All three update automatically on Fed, Treasury.gov, and the NY Fed's public dashboards. No subscription, no login. These are mechanical outputs, direct readings from the same dollar funding infrastructure where gold clears, settles, and serves as high-quality liquid asset, HQLA. You never wait for gold to move. You watch these three dials, and when they align, gold isn't about to react. It's already pricing the strain. That's your signal. Not later. Now.